Hello and welcome to the Business Standard Morning Show. I'm Thirumoy Banerjee and here's a look at the stories for the day. After 3 years of aggressive buying, foreign portfolio investors slammed brakes in 2022 and withdrew 1.21 trillion rupees from the Indian stock markets. The sellout was more aggressive in the first half. Overall, the market is on course to witness the highest ever FPI outflows in any calendar year. So, why have FPIs turned negative on India in 2022? Bhashwar Kumar brings you the answer.
India, which is being seen as a bright spot in a shaky global economy, saw foreign portfolio investors turning net sellers in 2022. They had been net buyers in the previous 3 years. So far this year, FPIs have pulled out 1.22 trillion rupees, or almost $17 billion, from the Indian stock market. In fact, they are on course to pull out the most in any calendar year. There are several reasons for FPI outflows, from interest rate hikes by major central banks to fears of a global recession. Investors have become more risk averse because of rate hikes and monetary tightening by central banks, including the US Federal Reserve. They have been skeptical about whether policymakers will be able to tame inflation without triggering a recession. Amid tightening by the Fed, the US bond yield has risen sharply from where it stood at the start of the year. The depreciation of the rupee has also added to foreign investors' nervousness. A fall in the rupee eats into the returns of FPIs. Another reason for a pullout is the spike in commodity prices caused by supply disruptions due to the Russia-Ukraine war. Against this backdrop, what do market experts see as the most important factor behind the outflow?
So central bankers, as they started tightening and started pulling out money, which they have probably started pulling out like close to about $1 trillion has gone out of by way of, I think, the liquidity suck out that they have done. The obvious impact is on the interest rate. From a 0% interest rate territory in US market or negative interest rate territory in some of the European and Japanese market, today most of the countries have actually entered into the positive interest rate territory, which means I think US today is I think around 4% kind of interest rate. In my viewpoint, I think this is the single largest factor for the FIIs to pull out money from equities and start putting money into debt because of I think this sharp rally into the debt pricing that they have seen in last few quarters. Otherwise, and this particular FIs which you are counting on, they are actually ETFs. They are the traders. They trade across asset classes, and they would probably, in a given situation, when they see the rally which they saw in the last 2 years, they put money into equity. Today, I think they are seeing the opportunity into debt, so they are pulling out money from equity and putting this money into the debt. Who knows tomorrow if I think that starts becoming relatively less attractive and saturated? Quite possible that going forward in subsequent 2 quarters or so, they would probably start once again putting this money back into equity.
After a good 18 months of bull run, it was a good time for the FIs to book profits, especially when the domestic mutual funds were flush with funds to absorb the selling. The FI sales were due to a couple of reasons. First and foremost was the expected Fed hike and then the hawkish stand taken by the Fed with the multiple hikes during the year, which resulted in a strong dollar. Secondly, the Russia-Ukraine war, which started in February 2022, initially created an environment of uncertainty with rising crude prices, which normally meant a flight to safety. So we saw FIs withdrawing from the emerging markets. And then when a market corrects with such heavy selling, especially after a super bull run, those sitting on the fence to jump in before it's too late for them.
Also, amid the outflows, is there any trend that has stood out?
I think the main reason for FPI outflow is the strengthening of the bond yield. And because of that, I think they've switched over from equity trading class, I think, to bond trading class. So that is where I think they've switched money from equity to bond, largely for the purpose of trading. I don't think that any fundamental investors or the long-term investors from the FPI side has exited the market. On the contrary, I think we are seeing systematically inflow of money into the FPIs from the deals which are basically fundamentally driven or long-term investment driven. Long-term investment climate has not changed. On the contrary, if you notice the larger amount of investment deals which are happening in the country, particularly in the area of PLI schemes, particularly in the area of infrastructure funds, I think which the government has been attracting into, I think you are basically seeing a very large amount of long-term investment coming into the country.
Despite heavy FPI selling, the Sensex has managed a year to date gain of 4.8% on strong domestic flows. According to analysts, sustained FPI outflows could incrementally pressure markets going forward. However, the potential for incremental outflows could be limited given that FPI ownership of Indian equities is at a multi year low. So, how are FPIs likely to view India in the coming year? And how will the markets be affected?
So between the FPI and FDI inflow of money, I think India attracts somewhere around $100 billion every year. And I think this money could possibly go up only given the size of infrastructure projects that we are attracting world investors into. Last year, we budget allocation was 7.5 lakh crore from the government side for spending on infrastructure. This year, given the kind of robust tax collection, my readings and stable commodity prices, my reading says that government may be encouraged to put more amount of money behind infrastructure, somewhere around 8.5 to 9 lakh crores. I think could be ultimately be allocated to the infrastructure. Now, if this is the situation, then chances are quite high that you are going to attract more amount of money from the FPI side, from the FDI side as well.
Though many of us believe that global recession is there for real in 2023, but in India we may see a slowdown but no recession. We are poised to outperform and possibly could see some of our best years yet with a strong government at the center. China plus one and now Europe plus one may also play out. With our markets outperforming, FIS can't afford to ignore us. Finally, liquidity finds its way to markets which are performing, and India would prominently be one of them.
In the longer run, emerging markets that are doing well, including India, will attract flows. In fact, some experts feel that India might attract flows even outside of the emerging market funds due to its economic outperformance.
The effect of US Fed rate hikes has been far and wide. Not just the FPIs, but companies across most sectors have turned circumspect, fearing a slowdown in demand. Co-working giant WeWork is also feeling the heat as the tech industry is tightening the purse strings. Amid all this, the company is striving to gain a foothold in big Indian cities. To know more about the plans, Business Standard's Surajit Dasgupta caught up with Kiran Virwani, who is the founder and CEO of WeWork India. Let's listen in to the interview.
There has been obviously pre-COVID, COVID, and a sort of a post-COVID scenario in the co-working business. In these different phases, how has co-working space grown? I mean, as people go back to their offices, has that slowed down the process?
And 5 years ago, when we started, the term itself, co-working, was this communal working as a concept, which was very much limited to startups, freelancers, and maybe some MSME type of businesses. But basically, all of the companies that these large tech parks or large sort of office spaces were not catering to, that was the reason why we got into this business, was to try to build an infrastructure and a community for for smaller companies to use the network ability or the network effect of being in a space with other startups, and use that to their advantage to kind of grow. But I think since then, there was a huge evolution in the kind of customer base, and when we launched in India, we started seeing hints of these enterprise companies also adopting this model for various reasons, which became um, you know uh, obviously contract flexibility. It became a cost advantage or cost arbitrage. It became a reason for having one sort of vendor operator or someone outsource the entire office space requirements. And then also for attracting and retaining the best talent, the atmosphere that we created within our spaces helped these large enterprise not only attract good talent, but keep them engaged and happy in this workplace, because they had all of these other startups and other smaller businesses around them that created this very like innovative, high energy type of atmosphere that you see within a lot of our spaces. And so even pre-COVID, we started to see the adoption slowly trickling from small businesses to large businesses, but it was still, I would say in the process of happening. So just before pre-COVID, I would say 2019, 2018 was like the peak boom for all of us in the co-working space, at least in India. Then came, COVID, which obviously impacted the business, in a very sudden way. But it also showed companies, the value proposition that we were always explaining, which was, when things go bad or when things are uncertain, our model actually works well for your business because you can actually shut off that cost, or you can limit that cost that you're holding for the period that it is. And so as soon as lockdown started lifting and people actually started coming back, it was actually the smaller businesses, the startups, the guys who were like heavily impacted, who started actually coming out of their houses and coming back to the office first, which was primarily our target segment, and we started to see like a very quick uptick. The other thing that changed was that the employees' mindset, or like employees' ask to the employer, also changed. The employees started saying, "I now have realized I don't have to be in the office every day. I don't have to travel to like a central office every day. So I want flexibility kind of built into my schedule, and I will deliver the same amount of productivity whether I'm in the office or I'm at home."
What is like your current ratio between the larger enterprises and the startups today compared to say during the COVID period and the pre-COVID period? How has the model changed in terms of
So pre-COVID, we were, about 50% enterprise, 50%, I would say startups, SME and MSMEs. Today, we're more like 70% enterprise and 30%, startups, SMEs, and MSMEs.
the other thing is that after post-COVID, there's been a lot of talk of decentralizing the workforce. So how much has that requirement impelled you to move beyond just the metros, and how deeper are you planning to go?
Yeah. So as a brand and as a platform, we, definitely as a strategy want to continue to stay in the top six or, eight metros. And we believe that, even though COVID had created this dispersed workforce within the smaller cities, a large population of those are actually coming back for multitude of reasons. One being that the companies themselves are mandating people back into their offices. That social infrastructure in the smaller towns, which is restaurants, theaters, bars, those kind of things are still not in a place in which someone who's looking for like a high enough paying job, wants a certain quality of living, which is with the top six metros, or still have a huge delta over the tier two cities. And then I think the third part is like the pay differential that companies are applying. If you choose to work in a tier two town versus like come into the metros, a lot of companies are actually creating a range within pay as well. So in order for the employees to want a higher pay, I think that they will come back to the metros. But as we work as a flex, as our flex space and as our co-working type of business model, we will stick to the top six cities.
What is the kind of investment you will require, and how are you looking at funding this whole expansion?
So we've, over the last, I would say in the last 4 years is when a sizable chunk of our investment went in. So, as between Embassy and WeWork, we've invested upwards of 250 million into the business already. The good part is that over the last, 12 months, the business has been profitable, and is actually generating really healthy EBITDA margins, which is making sure that we don't have to actually raise any capital. So from an operational standpoint, we're like more than comfortable. And as a team, we don't expect to grow too much more because we are just doing a reoccurring rollout every year over year. Um, and the only thing that we actually need capital for is CapEx, which is to go into the fit outs. A large part of which actually we are seeing that the landlords are themselves participating with us, and investing in it. So with all of that, we have a very limited need for fundraising.
Great, wonderful talking to you.
Moving to markets, the recent fall in global fertilizer and natural gas prices are likely to bring respite to fertilizer companies. However, analysts caution that the Russian export duty on fertilizer may have a trickle-down impact on the Indian industry. Our next report has more on it.
Western nations slapped sanctions on Russia when the Russia-Ukraine war broke out in February. This led to a sharp rise in prices of key fertilizer components such as urea and DAP or diammonium phosphate. But the prices stabilized as economic activity gained momentum post-resumption of production across European and Chinese plants. The prices of urea and DAP fell by up to 50% from April peaks. Natural gas prices, a key ingredient in making nitrogen-based fertilizers, also fell by 100% from their highs in June. With the fall in input prices and hopes of higher subsidies for urea in the upcoming budget, analysts believe fertilizer stocks will maintain their rally going ahead. So far this calendar year, shares of Coromandel International, Deepak Fertilizers, Madras Fertilizers and RCF have soared up to 196%. In comparison, frontline indices Nifty 50 and the S&P BSE Sensex surged nearly 5% during the same period. Since India's fertilizer imports from Russia surged 371% to a record 2.15 million tons in the first half of this fiscal year, experts believe Russia's recent 23.4% export duty on all types of fertilizers may have a trickle-down impact on India.
Russia-Ukraine war seems to have been a blessing in disguise for the fertilizer sector. Initially, it was a shock with the input costs, which are mostly imported, shooting up, due to which the government had to increase the subsidy to cushion the effect on the farmer, which is again the focus area for the government. But in the recent past, we have been able to import from Russia at discounted prices. At the same time, overall raw material costs have also started coming down. Also, the recent decision by Russia to impose export tax will have a trickle down effect on India, but it's expected that we would be stocking up imported fertilizers even for the next Kharif season. So, the impact in the near future could be limited. Also, it's likely that the subsidy on urea in the upcoming budget would also be increased. So my picks for the time being, in fact, where I find value is Chambal Fertilizers and GSFC.
Moreover, analysts also believe that the likely rise in the maximum retail price of phosphatic and potassic fertilizers would bring margin relief to fertilizer firms.
Two things is happening over there that the government is planning for some more relief for this sector by increasing the MRP for PNK fertilizer, and that is one thing that the government is really planning to boost this sector. Another thing is that the fixed cost and the input cost for this sector is coming down. The gas prices is dip a bit, and so that is also helping this sector to improve their profitability. And if you see the crop, Rabi crop, the initial report, if you go by the initial report, that has been good. So all these things together, I believe, is going to be positive for the entire sector. But for a recommendation perspective, I believe we are very positive on Coromandel fertilizer. Along with that, from agri input perspective, we are positive on UPL, Sumitomo Chemical, and PI industry.
As of today, amid a lack of domestic triggers, global cues, rupee movement, crude oil prices, and foreign fund action will guide domestic markets.
The year 2022 was hard on financial markets across the world. And now, towards the fag end of this year, as Christmas is approaching, investors are still clinging on to some hope, this time from Santa. Markets usually rally on the last 5 trading days of the year and the first 2 of the new year. This phase is called the Santa Claus rally. Our next report decodes it for you.
US inflation has finally started showing some signs of moderation. It came down to 7.1% in November from 7.7% in the previous month, giving some breathing space to the Federal Reserve. Crude prices too have cooled down. All of this has set a good stage for the upcoming holidays as another eventful year comes to a close. But wait, what about the Christmas gifts from Santa? It is not just the kids, but seasoned investors too patiently wait for the year-end for goodies. And Santa doesn't disappoint them. Those 7 days, the last 5 days of December and the first 2 of January, are historically the most bullish periods of the year. Although many seasoned investors remain cautious and attribute this rally to just a feel-good factor, data suggests that US stocks have given a positive return of 79% in December since 1926. The S&P 500 index, considered a barometer of US stock performance, was positive during those 7 days in 15 of the 20 years. So the odds are clearly in the favor of Santa. This year-end rally is known as the Santa Claus rally. There is still no clarity on why markets often see a jump during those 7 days. Analysts cite different reasons for this. One is tax harvesting. During this period, investors sell losing investments for tax reasons only to buy back into the markets to improve their short-term tax position. Fund managers too get their portfolios ready for end-of-year position reporting. And some also attribute it to the Christmas and year-end optimism. A study done by a business daily suggests that the Indian market tends to outperform global peers during this period. Analysis of data over the last 30 years in December shows that the Sensex has closed December in the green 73% of the time, while the Nifty 50 ended December on a positive note 77% of the time. So Indian investors too are eagerly waiting for this year-end rally against the backdrop of a bleak December. The year 2022 was hard on US financial markets. Dow has fallen 8% so far, S&P 18% and Nasdaq 31.55%. And the central banks worldwide are refusing to relent in their fight against inflation. So while markets desperately need a Santa rally, the pitch is queered. John Leeper, CIO of Titan Asset Management, recently told Reuters, "Forget the Santa rally. The Fed looks more like the Grinch this Christmas."
I will achieve. I will fly high. FPI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Past performances also tell us that the financial markets are unpredictable. So, one should also weigh other factors before making an investment call. Impending recession in the US and the outbreak of COVID-19 in China are certainly not sending good signals to Santa. That's all for today. For more news and analysis, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.